Have you ever wondered how the S&P 500, a market index representing the stock market's performance by reporting the risks and returns of the biggest companies, could be influenced by dark pool activities? It might sound like a plot out of a financial thriller, but let's break it down. The S&P 500, or the Standard & Poor's 500, is a stock market index that tracks the performance of 500 of the largest companies listed on the U.S. stock exchanges. Think of it as the pulse of the U.S. equity market. It's an essential tool for investors to gauge the overall health of the stock market and the U.S. economy. Now let's switch gears and talk about dark pools. Contrary to its ominous name, dark pools are private exchanges where trading activities take place away from the public eye. These exchanges are often used by institutional investors to trade large blocks of shares without causing dramatic price changes that can happen on public exchanges. But here's where the mystery begins. In the shadows of these dark pools, large-scale transactions take place, often with little to no transparency. These trades can potentially influence market dynamics, including the S&P 500. The question is, how? And to what extent? The answers aren't straightforward. There's an ongoing debate about the role of dark pools. Some see them as a necessary tool for institutional investors, allowing them to execute large trades without disrupting the market. Others view them with suspicion, concerned about the lack of transparency and potential for market manipulation. The intricate relationship between the S&P 500 and dark pool activities is a complex web of supply and demand, market dynamics, and financial strategies. It's a fascinating world, full of intrigue and multi-layered mechanisms that can have ripple effects on the wider market. As we delve deeper, we will unravel the intricate relationship between the S&P 500 and dark pool activities. Stay tuned as we explore this enigmatic world where finance meets mystery. How does the law of supply and demand shape the S&P 500 index? Now that's a question that gets to the heart of the stock market's fascinating dynamics. First, let's get a handle on what we mean by supply and demand in this context. In the simplest terms, supply refers to the number of shares of a particular stock available for trading, while demand pertains to the number of shares investors want to buy. When more people want to buy a stock, high demand, the price goes up. Conversely, when there are more shares for sale than people want to buy, high supply, the price goes down. Now let's bring the S&P 500 into the picture. This index is a market capitalization weighted index of the 500 largest publicly traded companies in the U.S., and its value is a good indicator of the overall health of the U.S. stock market. But how does supply and demand factor into this? Let's imagine a day of trading. Shares are being bought and sold, with prices fluctuating in response to the tug-of-war between supply and demand. If investors are bullish, that is, they believe the market will rise, they buy shares. This increases demand, pushing prices up, and consequently the value of the S&P 500 rises. On the other hand, if investors are bearish, they sell their shares. This increases supply, prices fall, and the value of the S&P 500 declines. This dance between supply and demand is an ongoing waltz, with the tempo set by a multitude of factors, from economic data and company earnings reports to geopolitical events and even investor sentiment. Each investor, with their buying or selling, is a dancer influencing the rhythm and flow of the market. So, there you have it. The law of supply and demand is not just a dry economic theory, it's a living, breathing entity, shaping the S&P 500 index every trading day. But it doesn't end there. The dance between supply and demand is a constant in the S&P 500. But how do dark pools fit into this equation? Stay tuned, as we delve deeper into the world of dark pools in the next scene. What happens when you throw dark pools into the mix of market dynamics? Well, to answer that, let's first get a handle on what dark pools are. Picture a private club where financial transactions occur off the beaten path, away from the public eye. This clandestine market is what we call a dark pool. Originally, dark pools were created to allow institutional investors to make large trades without causing a significant market impact. Imagine trying to sell 1 million shares of a company on a public exchange. That could potentially cause the price to plummet before the entire order is filled. Dark pools provide a solution to this problem by keeping these large transactions under wraps until they're completed. But how do they affect the supply and demand dynamic? Well, by operating outside the public exchanges, dark pools can influence the perceived supply and demand of a security. Large buy or sell orders that would typically impact the market sentiment remain hidden in dark pools until they are executed. This can lead to a disparity between the actual and perceived supply and demand of a security, which in turn can impact its price on the public exchanges. For instance, if a massive sell order is executed in a dark pool, the public market might not feel the impact until after the fact. This could lead to sudden price changes in the S&P 500, catching traders off guard. Now, this isn't to say that dark pools are all doom and gloom. They do have their benefits. For one, they allow institutional investors to execute large orders without disturbing the market. Additionally, they provide a certain level of anonymity, which can be beneficial in strategic trading. However, they also have their drawbacks. The lack of transparency can lead to price manipulation and can leave retail investors at a disadvantage. Plus, the potential for sudden, unexpected shifts in the market can create a volatile trading environment. Dark pools, with their shrouded operations, add a layer of complexity to the interaction between supply and demand. These private trading venues are a critical part of the market ecosystem, influencing the dynamics of supply and demand, and subsequently, the S&P 500. So, what is the real impact of these dark pool activities on the S&P 500? A question that piques the curiosity of many investors and traders alike. Let's embark on a journey of exploration, assessing different viewpoints on the impact of dark pools on the S&P 500. The first perspective we'll delve into is the potential for price manipulation. Dark pools, by their very nature, are less transparent than public exchanges. This lack of transparency may provide an avenue for unscrupulous traders to manipulate stock prices, affecting the S&P 500. Imagine a scenario where large orders are executed in a dark pool, away from the public eye. This could potentially shift the price of a stock in the S&P 500, impacting the index's overall performance. On the flip side, some argue that dark pools may actually help the overall market. How, you ask? Well, by providing a platform for large institutional investors to trade sizable quantities of shares without immediately impacting the market price. This, in turn, could lead to more stable prices in the S&P 500, offering a level of protection against drastic price swings. However, it's important to note that these are merely viewpoints. The reality is that the impact of dark pools on the S&P 500 is complex and multifaceted. It's influenced by numerous factors, such as the volume of trades, the nature of the participants, and the specific rules of the dark pool in question. Moreover, the debate over the impact of dark pools isn't limited to the S&P 500. It extends to the entire financial market, stirring passionate discussions among market participants, regulators, and academics. While the impact of dark pools on the S&P 500 is a subject of debate, their existence is an undeniable part of our modern financial landscape. As we continue to navigate this intricate world of finance, it's essential to stay informed and adaptable. After all, as the saying goes, knowledge is power. So keep questioning, keep learning, and let's continue this journey together. So, where does this leave us in our understanding of the S&P 500 and dark pool activities? We've traversed the landscape of the S&P 500, one of the most representative and influential stock market indices globally. We've unpacked its dynamics, particularly how supply and demand, the fundamental principles of economics, govern it. As the number of shares available for trading, supply, and the desire of investors to buy, demand, fluctuate, so does the S&P 500. Then, we dived into the deep, murky waters of dark pools. These private exchanges or forums for trading securities operate away from the public eye, offering anonymity to large institutional investors. We explored how these dark pools impact market dynamics, including those of the S&P 500. By operating in the shadows, dark pools can influence the supply and demand of stocks. They can lead to price changes that are not immediately visible to the public market, creating a ripple effect that can impact the S&P 500. Dark pools, while often seen as mysterious and potentially disruptive, are a significant part of our modern financial ecosystem. The connection between supply and demand, the S&P 500, and dark pools is intricate and complex. It's like a dance, with each element responding and adjusting to the moves of the others. Grasping this dance, understanding the steps and the rhythm, can give investors a unique perspective and potentially a competitive edge. But remember, this video is just the tip of the iceberg. The world of finance, with its indices, dark pools, and other phenomena, is vast and ever-evolving. It invites further exploration, learning, and understanding. It challenges us to ask questions, seek answers, and continually expand our knowledge base. As we continue to navigate the world of stock trading, Understanding phenomena like the S&P 500 and dark pools becomes crucial to making informed decisions. Remember, knowledge is power in the world of finance.